Hello everyone, good morning, good afternoon, good evening, depending upon when you're watching this video lecture. In the earlier sessions, we discussed about some of the basic concepts of ratio analysis. Also, we discussed two types of ratios. One is liquidity ratios and the second one is capital structure ratios or long-term solvency ratios, including capital structure ratios and coverage ratios. Now let us continue the discussion on other types of ratios and respective formulae and what is the usefulness of these ratios. The third category of ratios is activity ratios, sometimes called efficiency ratios or performance ratios or turnover ratios. Basically, these ratios are there to evaluate the efficiency with which the firm is managing and utilizing its assets. Of course, this can also be called as asset management ratios. How effectively and efficiently the assets of the organization are being utilized will be indicated by these ratios. And what are these ratios? All of them having same name, that is turnover ratio. So what kind of turnover ratios can be there? Total assets turnover ratio, fixed assets turnover ratio, capital turnover ratio, current assets turnover ratio, and then there can be working capital turnover ratios, within which there can be three more other types of ratios like stock turnover ratio, inventory turnover ratio, which we might be already knowing from costing, and other ratios are receivables turnover ratio and payables turnover ratio. These are the various turnover ratios. In general, all these ratios mostly talking about the usefulness of the assets. So except the payables turnover ratio, all other turnover ratios are better if they are high. Means how many times each of these assets is getting turned over in a particular year is what is turnover ratio. In other words, how many cycles are there for the utilization of each of these separate assets when compared with something else. Generally that is sales, sometimes it can be cost of goods sold, etc. But except this creditors turnover ratio, of course, ideally better that creditors turnover ratio be lower, since it is not an asset, creditors is a liability. Keeping that apart, we'll come to that later. Normally all the turnover ratios are better if they are higher. So higher these turnover ratios, we can say better an organization is performing. Once again, the turnover also depends upon the nature of the organization. We cannot compare the turnover ratio of a manufacturing concern with a hospitality group. We cannot compare the turnover ratio of a restaurant with that of a normal software company or something like that. So each type of business will have its own nature. According to the nature only, any of these ratios actually, not only turnover ratios, whether it is liquidity ratios or capital structure ratios, or for that matter any ratio, will have its own characteristics depending upon the nature of the business. So comparability has to be ideally among those organizations which are in the same field. Let us say if you compare two ratios or one ratio, any ratio between two companies, say Infosys and TCS, no problem, you can compare because the nature of the two companies is similar, if not exactly same, more or less similar. Both are software companies in the services sector. But we cannot compare the ratios of Infosys with Reliance. That doesn't make sense. So that logic applies to, for that matter, any ratio, and more particularly so the turnover ratios also. Interpretation and utilization of the ratios, will come to that later, but particularly the formula related to each of these turnover ratios, let us look at them one by one. First one is total assets turnover ratio. Understand one thing, mostly the numerator of all these turnover ratios is sales. Mostly, not always. If sales is not there, we can even take cost of goods sold also. But if sales is there and nothing is mentioned, definitely sales is the numerator, not only for total asset turnover ratio, for that matter any other turnover ratio also, except the working capital turnover ratios, we will see them later. So sales divided by something is a turnover ratio. So sales divided by what? What is the nature of the ratio? What is the name of the ratio? If it is a total asset turnover ratio, sales divided by total assets, that's all. That is the formula, simple to remember. Sales divided by total assets. Then fixed assets turnover ratio, same logic. Sales numerator guaranteed same, divided by fixed assets, because the name of the ratio is fixed assets turnover ratio. What are they indicating? How many times the total assets are employed to generate the sales. What is the ratio between the sales and total assets? What is the ratio between sales and fixed assets? So with the utilization of the total assets or fixed assets, if you are able to generate more sales, where the numerator is more, that means higher turnover ratio. That indicates a better performance of the organization, better efficiency with which the organization is using its assets. Total assets turnover ratio tells us about efficiency of the usage of total assets. Fixed assets turnover ratio tells us the efficiency of usage of fixed assets, as the name itself indicates. So numerator is same, denominator only changes. So higher the total assets turnover ratio or fixed assets turnover ratio indicates higher efficient usage of respective assets. Then we have another name, capital turnover ratio or net asset turnover ratio. Same thing, capital turnover ratio. So numerator is still the same, sales, divided by capital employed. That's what is net assets. In this case, net assets means total assets minus the outside liabilities. So in other words, for capital employed, better way, what we can call it as shareholders funds plus non-current liabilities. That is the best way of looking at capital employed. So that is the capital turnover ratio. Of course, here inclusive of the long-term loans and long-term borrowings that the company has taken in the denominator. It can have a different application also. In that case, we may not take the non-current liabilities, we may only take shareholders funds. In that case, net assets means assets minus outside liabilities. So assets minus outside liabilities effectively gives what? Shareholders funds. But that is not a very good indicator. That is why, rather than calling net assets, better way of using the correct name for denominator is capital employed, because the name itself indicates capital turnover ratio. So what is the capital turnover ratio? The sales divided by capital employed. So that's what is this capital turnover ratio. Capital employed will be shareholders funds plus non-current liabilities. Can we find it out in a different way? Yes. If you always remember the balance sheet, you can find the same things in different ways. Fixed assets, current assets, shareholders funds, non-current liabilities, current liabilities. Okay. What is capital employed we are talking? Earlier I told this can be even found out by using this formula, fixed assets plus working capital, which is nothing but fixed assets plus current assets minus current liabilities. What else is remaining? Remaining two things are these: shareholders funds plus non-current liabilities. That's what we are taking as capital employed. That is a better thing to be taken. So that is capital turnover ratio. So total turnover ratio is sales divided by total assets. Fixed assets turnover ratio is sales divided by fixed assets. Capital turnover ratio is sales divided by capital employed. Numerator is sales, denominator only changes according to the name of the ratio. In the numerator, if sales figure is not available, we cannot say, I cannot compute the ratio. You can use cost of goods sold. But if nothing is mentioned, sales is the better number to be taken in the numerator. Now, other things. Current assets turnover ratio, same thing. Numerator is same, sales. Denominator will be current assets. That's all. That is current assets turnover ratio. Working capital turnover ratio, same thing. Numerator is sales divided by working capital. What is working capital? We know that. Working capital is nothing but current assets minus current liabilities. So the point of all these turnover ratios so far, 5 different turnover ratios, whether it is total assets turnover ratio, fixed assets turnover ratio, capital turnover ratio, current assets turnover ratio, or working capital turnover ratio. In all of them, numerator is sales or cost of goods sold, as the case may be. Denominator only changes. And what is the denominator? We don't have to separately remember that. Name of the ratio itself will tell. Denominator will be total assets here, fixed assets here, capital employed here, current assets here, working capital here. So that only changes. Numerator is always sales or cost of goods sold, as the case may be. Generally sales. These are the 5 different turnover ratio. Now the working capital turnover ratio can further be classified into 3 more aspects, because usually as part of working capital there will be current assets and current liabilities, both are there. So within current assets, normally we take 2 major current assets. Cash we don't take separately for the turnover ratios. We take inventory turnover ratio, which you should already know. And now another ratio is debtors turnover ratio or receivables turnover ratio. Current liabilities majorly indicates only creditors turnover ratio. So the same working capital turnover ratio can be further classified into 3 more sub ratios. What is inventory turnover ratio? This formula you already know. But here what is the preferable numerator? Not sales. Here the preferable numerator is cost of goods sold divided by average inventory, average stock. Cost of goods sold by average stock. You know this in costing also. That is inventory turnover ratio. What is average stock? Opening stock plus closing stock divided by 2. That gives inventory turnover ratio. Cost of goods sold divided by average inventory. And which types of inventory we are talking here? Which goods are sold? Naturally finished goods. So here inventory turnover ratio, if nothing is mentioned, what type of inventories it is referring to? That is finished goods inventory. Why? Because we are taking cost of the goods sold in the numerator. Which goods will be sold? Finished goods will be sold. What is the cost of them? Divided by average inventory will give us inventory turnover ratio. Then, what if you want to know the raw material inventory turnover ratio? We'll come to these ratios more detailed manner in the chapter of working capital management. There is a separate chapter on that. And of course, the same ratios will be repeated there. And same formula also will have to be used there. Particularly those related to current assets and current liabilities only. Because we are going to talk about working capital then. In this chapter of ratio analysis, more than the working capital turnover ratios, we will be more interested in other type of turnover ratios like total assets turnover ratio, fixed assets turnover ratio, capital turnover ratio, generally these 3. Current assets turnover ratio, working capital turnover ratio, and further classification of them into inventory turnover ratio, if it is finished goods, raw materials turnover ratio, if it is raw materials, then the formula will again change. Denominator is average stock of raw materials. Again, raw materials opening stock plus raw materials closing stock divided by 2, that is denominator. Numerator here will be raw materials consumed, not cost of goods sold, because you are not selling the raw materials, you are consuming them. How much is the amount of raw materials consumed during a particular period divided by average stock of raw materials will give us raw material turnover ratio. But one point to be noted, if nothing is mentioned, if the word is used as inventory, we have to understand we are talking about finished goods. Then the formula is cost of goods sold divided by average stock. This is used very well in this chapter also, more frequently, so you should remember that very well. Raw materials turnover ratio can also be used, but rarely so. More application of these individual current assets and current liabilities related turnover ratios will be more useful in the working capital management. Here we will use them, but of course only to a limited extent. However, you should remember this formula, as I told already, irrespective of whether some formula is more important or some formula is less important. That does not matter for the remembering of the formula. They have to be remembered, all of them, no other option. So sometimes if it is mentioned as a stock turnover ratio, just like that, that means inventory turnover ratio only, cost of goods sold by average stock. If average stock is not there, then what, sir? Okay, if average stock is not there, you take closing stock. So whatever the stock available on the balance sheet date, that itself you will take. So depending upon the data, we have to change the formula. Flexibility is important, rigidity is dangerous in this chapter particularly. For that purpose, flexibility can only be there when you understand the formula very well. Why cost of goods sold is there in the numerator? Why average inventory is there in the denominator? What are we talking about as inventory turnover? Means whatever the stocks that you have in the form of finished goods, how many times they are getting turned over in a particular year? How many times those are being sold? But we are not taking sales. Rather than taking sales, we are taking cost of goods sold. Sales we will take when cost of goods sold is not available. Then second priority sales. But in other cases, earlier cases, first priority sales. If sales is not available, then only we will take cost of goods sold. So here cost of goods sold in all the other cases is not the preferable one. That is only an option if sales is not available. All the other cases. Whereas in the case of stock turnover ratio or inventory turnover ratio, cost of goods sold is first priority. If that is not there, then only sales can be taken. That is inventory turnover ratio or stock turnover ratio, normally representing finished goods turnover ratio. For raw materials turnover ratio, it is altogether a different thing. It has nothing to do with the sales. It is about raw materials consumed. So how much stock you are keeping? Naturally, you have to keep lower stocks. All these inventories, turnover ratios, for that matter, any turnover ratio except creditors turnover ratio, as I told, it should be higher. Higher means what? You are keeping lesser stock, and with that lesser stock, you are turning it over more number of times by selling them. In the case of finished goods. In the case of raw materials, by keeping lesser stock, you are able to use them number of times. Naturally, you will reduce the cost by keeping lesser stocks, but having the consumption more. How is it possible? When you do the inventory management as learned in the chapter of materials in costing, in reality, if it is applied properly using various techniques, including various maintenance of stock levels, economic ordering quantity, just in time, all these different types of techniques, if they are applied scientifically, these turnover ratios will be higher, which indicates the better efficiency of the organizational operations. That is one of the sub ratios of working capital turnover ratios. That is inventory turnover ratio or raw materials turnover ratio. Both are different. Both are not same. Inventory turnover ratio means we are talking about finished goods. Raw materials turnover ratio means we are talking about raw materials. Both are completely different. We should remember that. Then debtors turnover ratio are also called as receivables turnover ratio. Here also numerator can be sales, but is it proper to take all sales? Definitely not. Since we are talking about debtors, it is better only to take credit sales. Numerator is sales. Divided by what? Average debtors. So just like average stock earlier, here we have average debtors. or average accounts receivable. How to get average accounts receivable? Normally same thing, opening plus closing divided by 2 of debtors or receivables. So that is a formula for receivables turnover ratio. What does this indicate? It indicates a higher ratio indicates better collection. Lower ratio indicates poor collection or very liberal credit policy given to the customers. So higher ratio means what? For the lesser amount of debtors, you are having more credit sales. Credit sales are more, but average debtors is less. Means the debtors at the balance sheet dates is very less. Then only the ratio will be higher. That can indicate two things. One, either you are collecting very fantastically, your collection team is doing very well, the receivables team, or it also indicates you are having a stricter credit policy. You are not giving credit to many people, you are giving credit to very, very less people. That is a very strict credit policy. Both of them indicate a higher receivable turnover ratio. On the contrary, if there is a lower receivable turnover ratio, that reflects a liberal credit policy or inefficiency in collection of money from the debtors. So better thing always, as I told already, any of these turnover ratios, whether it is total asset turnover ratio, fixed asset turnover ratio, current assets turnover ratio, working capital turnover ratio, or capital turnover ratio, all of them, or for that matter inventory turnover ratio or debtors turnover ratio, higher they are, better the efficiency of the organization can be judged as. But what kind of efficiency? That is represented in different levels. Total assets turnover ratio represents the efficiency of better usage of all the assets. This represents the better usage of only fixed assets. This represents the better usage of capital employed. This represents better usage of current assets. This represents better usage of working capital. Inventory turnover ratio represents efficiency in maintaining inventories, means lower stocks but more sales. Debtors turnover ratio higher means it indicates lower debtors but higher sales, which means either you are very efficient in collecting the money or you are having a stricter credit terms. Good or bad depends upon the situation. But always, higher the turnover ratios, in general, that is better. Always, this word has to be remembered, in general. There will be always exceptions, no doubt about it. Particular case to case, things can be completely different. Let us say, some company is having lowest possible debtors turnover ratio. Very low debtors turnover ratio means it is having lot of stricter credit policy. Can we say it is good? We don't know. If it is losing sales because of that, its customers are not happy because of the stricter credit policy of that company, maybe over a period of time the firm might lose sales. So that lowest possible debtors turnover ratio is not something that is good. Our highest debtors turnover ratio is indicating better credit collection and all. Maybe the firm is squeezing money from the customers. It's like almost chasing the customers. So that may indicate other things also. So those exceptional things, variety things always will be there. If we go to them, none of these things we can learn. So while learning them, we have to understand from a generic point of view, in general, what happens. Exceptionally, anything can happen, whatever it is, doesn't matter. So, good or bad, when we say, if you go to the philosophical level, nothing is perfectly good, nothing is perfectly bad. But in general, do we consider that as good? Yes. That's all. So for all these things in financial management, we can consider all these various aspects, whatever we are talking about, not now, even in future in this subject. We have to understand the financial management is always about a balance. You remember a old type of circus where there will be two poles and somebody will be managing on this. I don't know how to draw much, but some person will be having a stick in his or her hand and they will balance it. That is what is financial management. It is about balancing. It is a circus. If you say going rightwards is good, no, you may fall. Going leftwards is good, maybe no, you will fall there also. So this is good, that is bad, this is right, that is wrong, left is good, right is bad, right is good, left is bad. Any of these things cannot be told. Highest possible turnover ratio is good. No, we cannot say that. But better the turnover ratio, better it is. That much we can say. So extremes will never work in any of the areas of financial management. That is why that balance is required. Same thing happens to debt also. We have discussed about the capital structure ratios. Higher the debt, higher we call it as financial leverage is high. That will also automatically indicate the financial risk is high. So some people immediately jump to conclusion, oh, dangerous, debt is not good, we should not have debt. No, that is absolutely wrong conclusion. Debt is super, debt is good. We'll see that later in this chapter of capital structure, cost of capital, why debt is good. So that is what again and again I am repeating. You cannot have a one-sided, like a biased opinion on anything in financial management. It is always a balanced opinion, balanced understanding. You don't need to have an opinion also. Who are we to have an opinion? We should only understand the concepts. Opinions, people who are managing the real life money, they will have. Judgments, they will have. That is none of our business to do these judgments or create opinions on any of these things. But having said that, should we know what is normally correct? Yes. So that is the main point to understand. Like we are going to discuss definitely again later in other chapters also. Always remember this example in financial management. Whatever we talk about, think about salt. And if you have any type of judgment on that, that itself will clarify everything. If I ask a question, salt is good or bad? Some people will tell good, some people will tell bad. Some people will tell yes, it is necessary. But question is how much necessary? That nobody knows. That will depend upon person to person, cook to cook, and place to place. So we cannot say generally that salt is bad. There are some dietitians who say no, salt is bad, don't use that at all. I know some people who got low BP because of that, and their life is ruined because of not at all using salt for years by following the advice of those people. Unfortunate. Salt is not that bad. But are we saying salt is good? Eat daily 1 kilo salt? No, you will die. So is it good or bad? We cannot judge that. That is none of our business. What is the business of a cook, if at all? The manager of salt. Here you are talking about manager of money. So what is good or bad depends upon the situation. It does not have any universal rule. But is salt required for creating a good dish? Of course, yes. Then there is no confusion. Definitely it is required. Without that, there is no taste to the food. But is that a wrong statement to say salt is required for food? No, it is not a wrong statement. But is it a statement telling that salt is great and salt is the only thing that is going to give a lot of flavor to the food? That is the most important ingredient in the food. All these things are unnecessary analogies from that. Those analogies we should not draw. My point is that. So to whatever extent we have to understand, to that extent only we have to understand. Liquidity ratios. We know that. Current ratio, liquid ratio, or quick ratio, or cash ratio, etc. All these things, higher they are, better they are. Simple, normally. Will there be an opposite contrary view? Of course there will be an opposite contrary view also. Saying that higher how much? Limit is there. Balance is required. Too much of, let us say, current ratio is there for a company. Can we say it is fantastic? We don't know. We may say it is fantastic also. We may say it is worst possible also. A company may have so much of stocks and debtors which it is not able to sell and not able to collect. Still it may have a super current ratio. So is that a good company? No, it is not. Entire analogy of higher current ratio is good is gone. So that situation tells us a different story. That is what I have been talking about in this ratio analysis. Particularly, in general, in the entire subject of financial management, we should understand the concepts to the extent they are applicable under normal circumstances. Exceptional circumstances will always be there. This extreme also will be there. That extreme also will be there. We should not be much bothered about them. That is not our area of thought. So, normally current ratio higher, good. Normally quick ratio, cash ratio higher, good. Normally higher the interval measure, how many number of days you can manage with your existing money. More number of days you can manage, you are better off, you are good, you are in a good position. So good. Like that, under normal circumstances, how they are they good or bad, they have to be looked at. Same with debt also, capital structure ratios also. Debt, very high it is, not good. Low it is, very low also, not good. Debt is like salt. It should be there, it should not be too much. If it is not there also, there is no taste. If it is there too much also, that will be spoiling the dish. So, this is the balanced approach that is required for understanding. Same way, turnover ratios also, for majority of them, let us say total asset turnover ratio is high, fantastic, nothing wrong with that, highest possible, still no problem, no issues, that's good. We cannot say a second opinion on that. Same with the capital turnover ratio, same with the fixed assets turnover ratio, yes, good. But when we say current assets turnover ratio or working capital turnover ratio or inventory turnover ratio or receivables turnover ratio, we cannot say the same thing because actual situations may be different. Sometimes these may indicate a wrong policy, not only efficiency. Efficiency is one thing, wrong policy is another thing. Sometimes things may look good on the face of it, but the reality of that may be different. Just for understanding, not that exactly it is related to this topic. Since you have economics for finance also, you should know these things. For example, the India's foreign exchange reserves have crossed now $600 billion. Super. Good news or bad news? Absolutely good news. No doubt about it. Fantastic. Looks like. But should we just go with that? No. Why? Because there is a bad news inherent in that. That also indicates our imports are going down. Again, that looks like very good, our imports are going down. That is fantastic. That also indicates foreign institutional investors are investing so much money in the stock market. That also is good, looks like. But what is the other side of the story? Also could be the foreign institutional investors who are bringing money now into the Indian stock market may take it away the moment bond yields or the interest rates in America go up. Now interest rates in America are so low because they don't have anywhere to invest. Most of the world's capital is coming to India in the form of investment in the stock market of India. That is why one of the reasons, even though our economy is not doing so great at the time of pandemic, our stock market is doing fantastic. Stock market is going up, up, up. One of the reasons is this. Alongside that will also increase our forex reserves because this money is coming from outside India to India, naturally in the form of dollars. So our foreign exchange reserves are increasing. So on the face of it, it looks fantastic. But if you only look at the face of it, if you don't understand the behind the story, then that is a wrong perception. What is the other side of it? The institutional investment which is coming from outside India may leave at any point of time. May, we don't know. So then these reserves will go down. Then there will be a very high pressure on the reserves position of the country. That is one point. Another point, the imports are low is a good news, but also that indicates our purchasing power of the people is not there. Our people are not purchasing because they don't have incomes in the pandemic. With the lesser and lesser incomes, what will they purchase? They are postponing their purchases, called discretionary spending. So naturally the imports are not required that much as they are required under normal circumstances. So since our imports are lesser, only nowadays most of the imports are only petroleum products, other than that there is no much imports. Naturally import bill is less and saves the foreign currency for us. So forex reserves are going up. So what is the other side of the coin? That has to be understood from the situation. But that is all again real life. As far as our understanding is concerned is about the ratios, We should only understand under normal circumstances what? Under normal circumstances, having higher forex reserves is a very, very good news. But are we talking about normal circumstances now? No. So we have to take it with a pinch of salt. Same way, even in the case of any of these ratios also, we cannot jump to conclusions, but we should have a general understanding of them. That is common, as I told. There is no need to break our heads. Simple. Any of the turnover ratios except creditors turnover ratio, higher it is, better it is. As simple as that. That is a normal general thumb rule. Exceptions will be there. All that we need to know is exceptions will be there. Not to be too focused about exceptions, not to be too worried about them. Our focus has to be on the main ratio. Main ratio here, in the case of debtors turnover ratio, is what we had: credit sales, net credit sales divided by average debtors. That is debtors turnover ratio. Now we have another word that is called debtors velocity. Means how quickly you are able to collect the money from debtors. This can be easily computed by taking this. Either 12 if you are calculating on the basis of months, 52 if you are calculating number of weeks, 360 or 365 if you are calculating number of days. In general, say 360 divided by debtors turnover ratio will give us debtors velocity. It gives what? Number of days. Means within how many number of days you are able to collect money from your debtors on an average. Let us say you have a credit sales of say 1 lakh rupees and your debtors on an average are 20,000. That means how many times you are rotating the average receivables, how many times the turnover is happening? 5 times it is happening, and this is what we are calling it as debtors turnover ratio. Turnover circles, that's all. How many rounds? 5 times, like that. So 5 times it is happening. 5 times if the debtors turnover is happening, for every how many days the turnover is happening? Number of days, that is called debtors velocity. Simply we can take 360 divided by 5. So 360 divided by 5, that can be 18 times. Is it? No, sorry, 72 times. So 72 days. 360 divided by 5 means every 72 days you are able to collect the money from debtors. Simple. On an average, every 72 days you will get all the money from your debtors. But is it going to be that every debtor will pay exactly after 72 days? No, these are all average things, on an average. So always we are talking about average. So simply how to calculate this debtors velocity? Also it is called as average collection period. Also it can be called as debt collection period. Within how many days you are going to collect the debt? Simple. 360 divided by debtors turnover ratio. 365 divided by debtors turnover ratio, 52 divided by debtors turnover ratio, then it will be in the form of weeks expression. If it is months, 12 divided by debtors turnover ratio, then the expression will be in the form of number of months. Normally it is number of days. Weeks and months is generally rare. Can be there. Once you know the concept, time period is just only a matter of just expression. But in general, 360 by debtors turnover ratio is what? Debtors velocity or average collection period or debt collection period is calculated with. That's the formula. We don't need to have separate formula for that. It is easier to have this 2-step formula than one formula. So I suggest go with this formula only. What is that? 360 divided by debtors turnover ratio. That is better. For that purpose, you have to first compute debtors turnover ratio. You know the formula for that. Net credit sales divided by average debtors. Net means here after sales returns and all these things are reduced. Credit sales divided by average debtors gives debtors turnover ratio. 360 divided by that will give debtors velocity. That is the number of days within which on an average you are able to collect your receivables. That's the other sub component of working capital turnover ratio. These are all current assets related. Now we are coming to the payables turnover ratio. Payables is current liability, but still logic is same. In case of debtors turnover ratio, we had net sales in the numerator. Now we will have net credit purchases. Instead of sales, we will have purchases because we are talking about payables, creditors. Average creditors, simple. average accounts payables. How to get average? Opening plus closing divided by 2. So logic, if you understand, all these formula can be remembered easily. Debtors turnover ratio is the credit sales divided by average debtors. Creditors turnover ratio is equal to credit purchases divided by average creditors. Names can be different. Debtors turnover ratio can be sometimes called as receivable turnover ratio. Creditors turnover ratio can be called as payables turnover ratio. Names, you should be able to understand what is the essence of the ratio, what the question is talking about. You cannot say, I know only creditors turnover ratio. Creditors turnover ratio, payables turnover ratio, both are same. Accounts payables, creditors, both are same. So here, credit purchases divided by average creditors will give payables turnover ratio or creditors turnover ratio. Now, all the other turnover ratios, we wanted them to be high. Means more number of times they are turning over. More number of times they are turning over. Now, for creditors turnover ratio, we want it to be low. Means lesser number of times we have to turn it over. Why? Because you don't want to pay the creditors many number of times. You want to pay them less number of times. For all others, you want to get that more number of times. So turnover should be high for every turnover ratio so far. Only for one ratio, because logic also you can understand, in all the turnover ratio, the denominator is always an asset. Whether it was total assets, fixed assets, or capital employed, that's a different story, though it is not an asset, but it is a total fund that is invested in the organization. Or whether it is current assets or working capital or inventories or debtors, all the cases of turnover ratios, denominator is an asset. Some resource, definitely, that is controlled by the organization. So that is denominator. Whereas in case of payables turnover ratio, this is a liability. So that is why you don't want to have many turnovers. Again, theoretically speaking, all the other cases you want to have more turnover. Payables turnover ratio, we want to have lesser turnover. So a lower turnover ratio reflects liberal credit terms granted by suppliers, and higher ratio shows accounts are settled very rapidly. Higher ratio means you are paying them quickly. Tuck, 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 you are paying very quickly, which is not that good if you look at financial point of view. So under normal circumstances, payable turnover ratio ideally should be low. Ideally. Once again, exceptions will be there. That is also there. Theoretically, what we are talking about is correct. All other turnover ratios should be high. Only creditors turnover ratio should be low. Nothing wrong with that theoretically. But practically, when you say the creditors turnover ratio is low, that means look at the other side of it. Payable velocity. Number of days within which on an average you are paying your creditors. That can be called as average payment period or credit payment period. Same way, 360 divided by creditors turnover ratio. This is the better formula and easy formula to be used. Don't use this. This is unnecessary. Gives more calculations. Since you can easily calculate creditors turnover ratio, you first calculate that. Then substitute here. 360 divided by creditors turnover ratio will give number of days within which you are paying the creditors. Let us say if the turnover ratio is low, that means number of days within which you are paying the creditors is high. Let us say if the turnover ratio, creditors turnover ratio is 5. As we calculated earlier, every 72 days you are paying the creditors. Let us say your creditors turnover ratio is 4 only. That means every 90 days you are paying your creditors. Means you are lagging your payments for creditors. That is good, no? Theoretically, that is good. But practically, we have to understand this should not be beyond the credit terms granted by the creditors. This in no way should be understood or interpreted as if we have to lag, we have to drag our payments to the creditors, let them come and beg us every week. After that only we will pay. Then also we will drag it, because sir told more the number of days it is good, less the turnover is good. No. That is not the interpretation of that. This is what lot of finance people wrongly interpret. And unfortunately, lot of finance people in the world fall for this false interpretation of it. And they try to actually harass their creditors by dragging their payments, by not paying them in time. And what is their explanation? That's what is financially correct. That's what our theory is told. No. What happens if you keep on dragging the payments for your creditors? In reality, I am talking, not theoretically, not financially, not from the conceptual point of view. In the practical point of view, if you have a payment due, but you want to pay it much later than that date, the creditors first of all will lose trust. What they will do is, over a period of time, simply what they will do is they will increase the cost. This is what I have observed personally in my international experience, where I used to work with MR properties. The payables team is huge there. More than 15 people used to be there in payables team. But I'm not a direct in charge of them. But since I was in costing there, ultimate reports used to come to me. And what I observed was these payables teams are actually not working at all. And they are not paying anything in time to the contractors. Huge money. We're talking about billions of dollars. Not even millions. Put together all contractors, billions of dollars, pending, not releasing the bills at all. And all the payables people are happy. They're actually not very professionals, to be frank, but still, they are thinking they are doing a good job by dragging the payments. What effectively happened in my observation, and I showed or proved to my CFO also, that because of this, the cost is increasing. And the contractors are giving the tenders, all of them, at a very higher cost, at least increasing the total cost by 20 to 25%. So if a particular building has to be constructed, let us say with a cost of $150 million, they are quoting $200 million. All the contractors. Because everybody knows this company will pay very, very late. Payments will not come. So what they will do? They will factor in this delayed payments interest cost also in that. They are not fools. They also are smart. They also have finance professionals working for them. Naturally, what they will do, this additional delay also they will add some cost, and more than that, the harassment what they get also they will add as a cost to that. They will not tell all these things, but they will quote high. As a result of that, the overall cost of the projects for the company was increasing tremendously, because I was not able to understand. Whereas in the case of other private developers where I worked with earlier, the private developer has to purchase the land cost is there. On top of that, construction cost will be there. And whatever is the total cost, X amount. For MR, only construction cost was coming to that much amount. Because land is free for MR. Most of the cases, it was given by the government. How is it possible? For a private developer, land was purchased at a very huge amount, plus construction cost, whatever the amount is. Only construction cost is coming to that much amount. First thing I thought it may be because of higher, huge quality that MR is maintaining. To some extent, yes. But that is not definitely accounting for this extra 25% cost. Maximum it will account for 5% cost. Remaining 20%, why is it happening? Because of delayed payments. Practically, people don't understand this. They think delaying payments and having a very long credit payment period is a good thing. No, it is wrong. So the finance professionals, at least you as future finance professionals have to understand, the theoretical things what we talk about exactly may not happen in the same way in reality. That is first point. Second point, yes, the creditor's payment period should be high, no doubt about that. But that is only normally within the credit period allowed by the creditor. If the creditor allowed 90 days, no problem. You take 90 days. Nobody says something wrong. But if the creditor allows 90 days, you will take 200 days. And you say that, yes, I have achieved a very higher payment period and a very lower creditor's turnover ratio, and I did a great job, I need an incentive or bonus. Any stupid finance chief can give bonus also. But unfortunate thing is that is a very wrong approach. In the long run, organization will lose. These people will get bonuses, etc. for their dismal performances in the short term. But in the long run, organization will lose a very huge amount in the form of higher cost. So that is the other side of the story. But again, as I said, other sides are only just to be known, not to be thought about very seriously. Main thing is what? When we have the payables turnover ratio low, that is better. Which means you pay the creditors a longer period of time. You pay them not very frequently, you pay them after little bit more number of days. That is a good thing. That's all. So that is the creditors turnover ratio. These are all various turnover ratios. And just to recapitulate quickly, the total assets turnover ratio, fixed assets turnover ratio, capital turnover ratio, current assets turnover ratio, working capital turnover ratio, inventory turnover ratio, debtors turnover ratio, creditors turnover ratio. These are all turnover ratios. In between there is a raw materials turnover ratio also, which is a sub ratio. Just for understanding that normally inventory turnover ratio means finished goods, raw material turnover ratio will have a different formula. That's it. These are turnover ratios. And some things to be noted, mostly common things only actually. See these points like selling and distribution expenses and cost of goods sold have to be known. So when normally in the case of difference the difference in the data that is available, cost of goods sold will be equal to cost of sales. So cost of goods sold, cost of sales, whatever you want to take, depending upon the situation, that can be taken, no problem. So when we consider cost of goods sold or cost of sales, why are we doing that? For eliminating the profit part, we can. But as I said, cost of goods sold is better to be taken only for inventory turnover ratio. Other than that, for any other turnover ratio, it is better to take sales. For debtors turnover ratio, you have to take credit sales. For creditors turnover ratio, you cannot take sales. Naturally, you have to take credit purchases. So keeping those apart, all other turnover ratios, numerator is same, that is sales. That's it. And whenever we are talking about average in the denominator, yes, you can take average also. Or if average is not available, you can take only the closing figures also. Any of them can be taken. That is also another point. And the same thing, always I keep on repeating, and the same thing is reiterated here also. Ratio shall be calculated based on the requirement and availability of information and may deviate from the original formulae. Definitely, if required, assumptions should be given. So don't be rigid. Don't say that that was the formula told, now a different formula is used. No, different formula is not used. A different type of formula is used, a different mode of formula is used, or maybe a kind of small deviation from the original formula is always possible. How? Why? Based on information. So always application of these ratios has to be very open-ended. In order that to happen, you should be thorough with the ratios first. Without being thorough with the ratios, application will always look very complex unnecessarily. And some people will ultimately say it is confusing. That complexity and confusion only happens when the thoroughness in the original formula is not there. When we know the original formula, a little bit of tweaking here and there, we can also easily understand. Original formula itself is not known or not remembered well, then the tweaking also will not be understood. So that flexibility is the essence of this chapter. Let me once again clarify that. Simple. Though I am telling this again and again, but you would like to tell this. I know this personally also. Let me tell this because I used to be very overconfident when I was a student while practicing this ratio analysis. I used to think, hey, what is there? Ratios are there. Formula you remember. Exam information will come, substitute, get the answer. I was overconfident. And in one of the examinations, this overconfidence got backfired. Then I understood, oh, it is not that. It is not just about just remembering the formula and substitution. We should be flexible enough. So we should remember the formula, definitely yes. We should be able to understand the interpretation of the formula, and most importantly, we should be flexible, not rigid. So remembering the formula very well and flexibility in the application of that formula is the key to success in this chapter. Once we have these two characteristics, it gives full marks. And one more point, let us be very clear once again. Financial management is such a kind of subject where you will get full marks only. There is nothing like if you do these things properly. Let us say 5 marks question is there. And if you have written the ratios formula, whatever is the ratio, you wrote the formula very clearly. This is the numerator, this is the denominator. Then you substituted the numbers. Then you showed the calculation, showed the final answer. If interpretation is asked, you wrote the interpretation also. Done. Full marks only will come. There is no other option. So very scoring. When these requirements are fulfilled. What are the requirements? Remembering the ratios, understanding them. Second, being flexible with the application of the ratios according to the information that is available and according to the requirement of the question. That's the key aspect of this particular chapter. Now moving on to the other category of ratios, the fourth category, and almost we can say the last category of ratios, that is profitability ratios. So far we had liquidity ratios, we had long-term solvency ratios, within which we had capital structure ratios also, coverage ratios also, and just now we discussed turnover ratios, that is easy word, efficiency ratios, whatever the name we give them, turnover ratios, because all of them have the name of turnover, so easy to remember as turnover ratios. Now the last one is profitability ratios. Within these profitability ratios, there are further categories. Certain profitability ratios related to sales, easiest one, and some of them you already know. Certain profitability ratios related to the return on investment, and certain profitability ratios from the owner's point of view, and certain profitability ratios related to market. Market means stock market, valuation, investors, shareholders. We are talking about public, particularly the listed companies will use the fourth category of ratios. So what are these ratios? One by one, let us look at them. First category, subcategory, profitability ratios based on sales, gross profit ratio, net profit ratio, operating profit ratio, expenses ratio. Name themselves indicates. Denominator is sales in all of them. What is numerator? Name of the ratio. Gross profit ratio is gross profit divided by sales. These are expressed as percentages multiplied with 100. By the way, all the turnover ratios were expressed as number of times. Number of times. Velocity, debtors velocity, creditors velocity is expressed as number of days. Other turnover ratios are number of times. So for each ratio, you should know the expression also, whether it is a percentage or number of times, like that. These ratios, the profitability ratios which are based on sales, are all expressed as percentage, that is why multiplied with 100. So how to get gross profit turnover ratio? Gross profit by sales into 100. Net profit ratio? Net profit by sales into 100. Operating profit ratio? Operating profit by sales into 100. Expenses ratios can be any type of expenses. Let us say cost of goods sold ratio. Cost of goods sold by sales into 100. Like that, each of the expenses ratios will have numerator according to the name. Denominator for all of them is sales. So that is the first category, that is profitability ratio based on sales. Let us quickly go through them so that we can easily understand these things. Nothing special to discuss. Most of them you already know also, particularly gross profit ratio. What is gross profit ratio? That is gross profit divided by sales multiplied with 100. That means out of 100 rupees of sales, how much is the gross profit? For every 100 rupees of sales, how much is the gross profit? That is a margin. That is also called gross profit margin or gross profit ratio. So gross profit by sales multiplied with 100. Should be higher ideally. If it is higher, that means the cost of goods sold is lower. And one point we should know here, sales minus cost of goods sold is gross profit. This should be already known. So let us say gross profit ratio is there, divided by sales. If you divide both the things by sales, so the cost of goods sold by sales and gross profit by sales, these two will be complements to each other, because sales by sales is equal to 1. So if gross profit ratio is high, cost of goods sold is low. Means for a lower cost, you are getting a better profit. Profit higher is better always. And here there is no other side of the coin and all. It is always good to have higher gross profit ratio. Net profit ratio, simple. Net profit by sales into 100. Or earnings after taxes divided by sales into 100. Net profit is earnings after taxes. Sometimes, if at all the question is asking about pre-tax profit ratio. Pre-tax means earnings before taxes divided by sales multiplied with 100. That's it. Should be higher or not? Yes, of course it should be higher. Higher it is, better it is. Operating profit ratio. What is operating profit? Generally, operating profit is this: earnings before interest and taxes. I told this already. Cash operating profit is different. Operating profit is different. Cash operating profit means that is earnings before interest, tax, depreciation and amortization. That can be called cash operating profit. We are not talking about that. We are talking about operating profit. So, operating profit ratio is simply EBIT, earnings before interest and taxes divided by sales multiplied with 100 is only an expression as a percentage. That is operating profit ratio. Should it be higher? Yes, of course it should be higher. What is operating profit? sales minus cost of goods sold, which is gross profit, minus expenses. Which expenses? Other than interest. So, except interest and taxes, all other operating expenses can be taken, including depreciation, because we are not talking about EBITDA. Sometimes in real life, EBITDA is a better representation of the operational performance of the organization. The operating performance of the business is more evaluated by EBITDA in real life. But if that is asked, it is okay. But generally at the CA intermediate level, EBITDA is not that much focused. So normally operating profit, what we talk about here is earnings before interest and taxes. That's all. So that is operating profit divided by sales multiplied with 100 will give us operating profit ratio. Expenses ratios. Which expenses ratios? Any type of expenses ratios can be there. Cost of goods sold ratio. Same thing. Cost of goods sold divided by sales multiplied with 100. Operating expenses ratio. Only operating expenses. Be very careful. It is not operating ratio. It is not operating profit ratio. It is operating expenses ratio. What will be operating expenses? Admin expenses, selling and distribution overheads divided by sales multiplied with 100. Only operating expenses. That is operating expenses ratio. Operating ratio is different. Operating ratio is cost of goods sold plus operating expenses divided by sales multiplied with 100. Now you can understand operating ratio and operating profit ratio will be complements to each other naturally. Why? Because what else will be there here in the numerator? It will be only profit. Operating ratio gives us cost of goods sold plus operating expenses. What are operating expenses? Admin expenses and selling and distribution expenses. Let us say plus cost of goods sold plus operating expenses plus operating profit by sales. That will be naturally 1. Why? Because cost of goods sold plus operating expenses plus operating profit is what is sales about. Because operating profit is nothing but sales minus cost of goods sold minus operating expenses, isn't it? That is why operating ratio and operating profit ratio, these two are complements to each other. Complements to each other means the total of them will be equal to 1. So this portion is called as operating ratio. This portion is called as operating profit ratio. Total of them will be equal to 1. That is one more. This is expenses ratios. These are not profitability ratios. These are not profit ratios. These are expenses ratios. Financial expenses ratios means only financial expenses. Financial expenses means generally what? Naturally, interest. And any other exceptional items will not be taken, like losses due to theft, etc. and all. They will not be taken. Only financial expenses will be taken, divided by sales into 100. In that, which will tell us out of the sales that you are making, how much percentage is only in the form of interest. So that tells us again the total level of the financial leverage of the organization. Higher the financial expenses, little riskier it is naturally. So each organization will have a different type of expenditure structure. So that is the point to be noted. And this can be understood from your costing understanding and costing knowledge, which you should already have a little bit of that, definitely. If a particular organization, for example, like a manufacturing organization, will have a very high cost of goods sold ratio, normally direct expenses will be high, materials will be highest, labor and other direct expenses will be highest. Maybe the operating expenses will not be that much, they will be little less compared to that. So for a particular manufacturing organization, there may be lots of cost of goods sold related expenses, means less gross profit, very less gross profit can be there compared with a service organization. Service organization may have a huge gross profit. Why? Because its cost of goods sold, in the sense services rendered, direct expenses may be very less. Maybe it will have more of overheads, more of office overheads, selling and distribution overheads may be more for that. So depending upon the nature of organization, once again, this expenditure structure, cost structure of the organizations can be understood and analyzed by using these ratios. Cost of goods sold ratio, operating expenses ratio, operating ratio, and financial expenses ratio will tell us the usage of debt in the capital structure and how much interest expenditure a particular organization is spending as a percentage of its sales. These are all various types of profitability ratios on the basis of sales Common point, if you observe, easy to remember them. Gross profit ratio is gross profit divided by sales. Net profit ratio is net profit divided by sales. Operating profit ratio is operating profit divided by sales. Operating profit is nothing but EBIT, which is also nothing but sales minus cost of goods sold minus operating expenses. That is operating profit divided by sales multiplied with 100 will give operating profit ratio. Expenses ratios can be many. There can be cost of goods sold ratio. In all the cases, name itself will be in the numerator, denominator is sales. There can be operating expenses ratio. Operating ratio is different, operating expenses ratio is different, operating profit ratio is different. These three are to be carefully observed in the questions. Operating ratio is operating expenses plus cost of goods sold divided by sales into 100. Operating profit ratio is different, operating ratio is different, operating expenses ratio is different, and other expenses like financial expenses ratios can also be there to indicate how much of interest expenditure is paid or incurred in a particular year when compared with its sales. Higher it is not a good thing. Expenses ratios should be lower naturally. Profitability ratios like gross profit ratio, net profit ratio, operating profit ratio should be higher, ideally. That's it. That is about one category of profitability ratios. Now coming to another category of profitability ratios, this is another category. Here the denominator is related to overall assets or investment. So numerator will be profit, but here the numerator will also change. Numerator will also change. Though the name is written, it need not be always the same thing in the numerator. Name is same, contents may not be same. That is why care has to be taken which formula we are using. So ideal things, as we know earlier, ideally numerator and denominator should match. They should have some bit of synchronization. If that is not there, then the ratio will be meaningless. That is why don't go by the names. Name says written. But what is that written actually? That will change from one formula to another formula. Here denominator is already given in the name of the formula itself. Written on investment, so denominator will be investment. Written on assets, denominator will be assets, total assets. Written on capital employed, denominator will be capital employed. Written on equity, denominator will be equity. So denominator is clear in these cases, numerator is changing. Of course, every type of category has its own natures. In the earlier cases, denominator is same, sales. Numerator was changing. Here, denominator is known from the name, numerator is more or less the same, but though name is same, the contents of the numerator will change. So, this category of ratios, profitability on the basis of investment, capital, etc. What are the formulae for that? Let us understand them one by one. In fact, there are lots of deviations, or we can say multiple types of computations that can happen when we talk about this category of ratios. So naturally, sometimes students may feel it is little complex or complicated. It is not complicated, complex or confusing. Only point is there are many variations, that's all. Name may be written on investment, but what is written, what is investment can change in different contexts. So essence is same. Name itself indicates essence. What is the essence? Return, okay, or profit, or you call it earnings divided by investment. Okay, easy to say that. Easy to say that. That is return on investment means return by earnings, return by sales into 100. But what is this return? What is this return? That has to be very important point to be understood. So this return can be different situations, in different situations, in a different way it can be defined. For a normal situation, what is this investment also can be different. We cannot have one thing as investment. But let me tell one thing, if nothing is mentioned, return on investment is return on capital employed. So keep this in mind. If nothing is mentioned, investment is capital employed. What is the amount invested in the business? Of course, capital employed. What is that capital employed? Of course, the loan capital plus own capital. What does it mean? Long-term liabilities or non-current liabilities plus shareholders' funds. Simple. That is capital employed. So if nothing is mentioned, this is okay. This is what is written on investment also, written on capital employed also. But There can be some other places where we calculate return on assets and only return on equity. Return on equity is not talking about others. Only equity means here shareholders funds. So let us look at each of them one by one. What is return on assets? Return on assets. Particularly, there are different ways of calculating this return on assets. There can be best way of net profit after taxes divided by average total assets. If average is not there, closing total assets. Or sometimes you can take net profit after taxes divided by average tangible assets only, without taking intangible assets. Or sometimes we can take net profit after taxes divided by average fixed assets only, without taking current assets. All are okay. But under normal circumstances, this is the formula we use. Assets means total assets. When nothing is mentioned, assets means total assets. So simple logic, return on assets means net profit by total assets. That is the formula normally used. Why I am talking about normally? Because in any particular question, a different formula may be asked to be used. We have to read the question carefully and understand the literature of the question and use that formula as required in that question. But under normal circumstances, return on assets is simple. Net profit means profit after taxes divided by total assets. That gives best way of telling us on the total assets that is employed, finally what is the outcome of the business? Net profit. You employed this much of total assets in the denominator. Let us say some 1,000 crores of assets are employed, but you got a net profit of, let us say, 200 crores. Then that means you have a 20% of return on assets, 20% return on total assets. That is what return on assets means. When nothing is mentioned, net profit after taxes is taken. Sometimes it can be taken as other than interest also. So normally when we say net profit, that is after taxes and after interest, right? Sometimes it can be taken as before interest. So sometimes it can be taken like this also, net profit after taxes plus interest divided by any of the thing. Average total assets, average tangible assets, or average fixed assets. Again, these two are exceptional. Normally average total assets is taken. So just taking net profit after taxes is one way. Net profit after taxes plus interest is another way. Or otherwise also it can be taken like this, EBIT multiplied with 1 minus tax rate divided by average total assets. This can be called as return on total assets, and EBIT into 1 minus tax rate divided by average net assets. This can be called as return on net assets. These many variations are there. Of course, under normal circumstances, it is just net profit by total assets. But if any other variation is asked, it has to be used according to the requirement and information given in the question. Normally, these variations are not separately asked or separately given. Even if they are asked also, the explanation of that will be given. So, if just return on total assets is asked, you can take either of them, net profit by total assets also, or EBIT into 1 minus tax rate divided by total assets also. Either of them is okay. These are just variations and different types of formula used for the same formula. So, just return on assets, return on total assets, return on net assets. Net assets is again simply as good as capital employed. Net assets is again capital employed only. So there is no new thing there. So that is one of the types of return on investment. Which investment we are talking about? Assets. Specifically total assets. Occasionally tangible assets, occasionally fixed assets also. That is one of the formula. But this is the most important and very common formula used for return on investment. Investment normally means capital employed. What is the investment of an organization? Capital employed. That is what is the amount invested in the organization. So return on capital employed is better to be calculated like this. So what is this? Return on capital employed. This can be calculated pre-tax and post-tax. So if it is calculated pre-tax, this is the better one. Earnings before interest and taxes divided by capital employed multiplied with 100. EBIT divided by capital employed multiplied with 100. This is the best formula for return on capital employed. If nothing is mentioned, return on investment also same formula. EBIT divided by capital employed. Why it is best formula? Because the capital employed in the denominator includes the long-term debt also, equity plus long-term debt, same thing, already we discussed this. Or it can be called as fixed assets plus working capital, or it can be called as total assets minus current liabilities. Any of them is same actually. Once again, if you only know the balance sheet, simply speaking. What is this? Fixed assets, current assets, let us call equity, which is shareholders' funds, non-current liabilities, current liabilities. That's all. Any balance sheet will be this only. So total assets minus current liabilities, capital employed. Fixed assets plus working capital, capital employed. Equity plus long-term debt, capital employed. All of them are same. That is capital employed in the denominator. That is same. However, numerator is better to be taken as earnings before interest and taxes. Why? Because in the denominator you are already taking this non-current liabilities, which is long-term debt. So that debt also is used in the business. That is why using this debt, how much earnings are actually made from the operations of the business is EBIT. If you take out interest, then that will not be good. Why? Because the denominator is inclusive of the debt, numerator is not inclusive of interest. That is why to match the denominator and numerator, best formula is EBIT divided by capital employed. But tax is okay. That is why post-tax, as an improvisation for this, EBIT multiplied with 1 minus tax rate divided by capital employed multiplied with 100. This also can be used if it is a post-tax return on capital employed. If nothing is mentioned, you can just stick to the pre-tax return on capital employed. If it is asked, then we have to talk about or calculate post-tax capital employed. On the contrary, this can be also done like this, as we have observed in earlier cases also. Net profit after taxes plus interest, add back interest, divided by capital employed multiplied with 100. Like that also it can be calculated. So EBIT into 1 minus tax rate or net profit after taxes plus interest, both will give more or less the same amount. So these two are going to be more or less same, but this is different. This is a pre-tax return on capital employed, and this is the first priority, by the way. These two are not priorities unless they are specifically asked. But of course, how much is pre-tax and what is post-tax, that we should know formula wise. That is about return on capital employed. Now, coming to the other type of return on investment, that is return on equity. Equity, here we are talking about the equity funds invested in the firm. So only for equity shareholders we are talking. Only for equity shareholders. What will be the profit available to the equity shareholders? So profit available to the equity shareholders, that is numerator. What will be that? Profit after taxes minus preference dividend, if any, that is only available to the equity shareholders, divided by equity shareholders funds. Once again, not shareholders funds, only equity shareholders funds, because in numerator we are talking about equity shareholders, denominator also we should talk about equity shareholders. So this tells us about how much return on equity is there for equity shareholders. This is a very good measure, and definitely even the potential investors and those who want to buy the shares in the stock market also will look at this return on equity more than the return on investment and return on capital employed, because that includes debt also. How much, if you are investing 100 rupees now, how much the equity shareholders will be getting as a return? Not that they will get in the form of dividend, but that money company is earning, definitely. So that money company is earning means who is company? Company is equity shareholders. Equity shareholders are the owners of the company. If company has profits, whose profits are that? Those profits are belonging to equity shareholders only. Whether they come to their pocket or not is a different story. They will come to their pocket only if the company pays dividend. But as long as the company is earning, that is belonging to them only. That logic you have to understand. So return on equity is earnings or profits available to the equity shareholders divided by equity shareholders funds. What are equity shareholders funds? Simply speaking, equity share capital plus reserves and surplus. That's it. That is return on equity. So this is a very, very important concept. Return on equity. Easy, because the name itself indicates earnings or profit available to equity shareholders divided by equity shareholders funds. Normally return on capital employed pre-tax is EBIT divided by capital employed multiplied with 100. If it is post-tax, EBIT into 1 minus tax rate divided by capital employed multiplied with 100. Normally return on assets means net profit after taxes divided by average total assets. Generally. But if at all, we have to take net profits before interest, that is a separate variety. Sometimes that can be taken as net profit after taxes plus interest divided by average total assets. Or even it can be taken as EBIT into 1 minus tax rate divided by average total assets. That is return on total assets or return on assets. These are the three different things within return on investment. See here, we talk about investment. What is investment? There is no particular definition. That is why we have three different situations of investment. In the first case, investment means assets, total assets, sometimes net assets. Return on total assets, return on net assets. Second case, return on capital employed. Capital employed is a very clear definition. There is no confusion. Return on equity. Equity is very clear. Equity means here equity shareholders funds. So these are various types of profitability ratios which are based on the total assets or the capital employed or equity. These are the four types of profitability ratios. Return on investment is not a separate ratio actually, though we can have return divided by investment. So what is return, what is investment? So many variations are there. So we cannot have one definition for return on investment. That is why return on assets we can have a clarity. Return on capital employed, yes, it is clear. Pre-tax, post-tax, whatever the case may be. Return on equity is very clear. So these are the second category of profitability ratios. Now moving to the third category and fourth category of profitability ratios. These are actually mostly from the market point of view, the stock market point of view, and these ratios we can discuss in the next session. That will be better because they have altogether a different type of approach. See, so far most of the things that we are looking at, whether it is liquidity ratios, who wanted them? Mostly the lenders. That too, short-term lenders want to look at liquidity ratios, and creditors will like to have liquidity ratios. Internally, the organization also will require all the ratios will be known and will be calculated by the management also, so that they can understand what is happening in the company. But the external parties like lenders and short-term lenders, banks, they will look at liquidity ratios, capital structure ratios, and coverage ratios. Who will use them? Mostly long-term lenders. Again, banks, financial institutions, debenture holders, potential debenture purchasers. All those people will try to look at these capital structure and coverage ratios because they want to know whether the company will be able to pay their interest or not, whether the company will be able to repay their original principal or not. That is it. So this is liquidity, means the ability to pay the short-term liabilities. Solvency means the ability to pay the long-term liabilities. Who will be interested here? Short-term lenders. Who will be interested in this? Long-term lenders. And then the third category of ratios, turnover ratios. This will be mostly internal management will look at them. These are not for outsiders. Outsiders may not be much interested in that. Mostly the management will be more interested in that, so that it can increase its efficiency. And that is why if you observe, most of these things are little bit related to costing also. That is why management accounting, costing, whatever we call it, management will be interested in knowing them. It wants to improvise its efficiency by having these turnover ratios better. Of course, any potential investor also can look at them. Any potential investor can look at all the ratios. That's a different story. Always will be there. Shareholders may be interested in all the ratios, but mostly by whom? Mostly by internal management. The turnover ratios will be analyzed and they will be used as a tool for improving the efficiency if they are not showing any good indicators. Coming to the profitability ratios, of course, internal management will be interested because they want to know their profitability, and not only that, the potential investors also will be interested in the profitability ratios. Why? Because they will be interested in the financial performance. Profitability ratios are the right and straight indicators of the financial performance of the organization. So when the performance of the organization, financial performance of the organization has to be analyzed, the potential investors, shareholders, even including the internal management, they will look at these profitability ratios. The first two categories of the profitability ratios will be mostly looked at by them. And even then, first category is more having the management's attention, first category. Second category will be having more of outsiders' attention, investors' attention. But the other three, third and fourth categories, completely, almost we can say market related ratios. Internally, management will have any decision on the ratios, yes. Depending upon the management's performance only, this will be ultimately happening. However, who will be interested in knowing these ratios will be always investors. So we have to bit of understand the stock market, what will be the investors' expectations, how this works, and what are the implications of all these, each of these ratios. And a very important aspect of the other two categories is they will be useful in the next chapters also. Coming chapters like cost of capital also, they will be useful. So we need a little elaborate discussion on that, which we will do in the next session. Till then, take care. Bye bye. Thank you very much.